Imagine you run a company that makes millions of dollars every single year, burying the dead.
Right. A very recession-proof business.
Exactly. I mean, you manufacture caskets, you pour these massive bronze grave markers, you build multi-ton granite mausoleums.
It's a heavy industry.
Yeah. And your revenue stream is completely insulated from standard economic cycles because you operate in a market of absolute biological inevitability.
People are always going to need it.
Always. But now, imagine taking the quiet, reliable cash flow from that solemn, steady empire and just funneling it directly into experimental dry battery electrodes for next generation electric vehicle gigafactories.
I mean, it sounds like a bizarre corporate fever dream, honestly.
Right. It sounds like two completely different companies that just got accidentally stapled together in a filing cabinet somewhere.
Yeah, a total mismatch.
But that is exactly what is happening right now at Matthews International Corporation. And welcome to Talk Tickers. For you, the retail investor tuning into this deep dive, our mission today is really to cut through the noise.
Strip away all that Wall Street jargon.
Exactly. We need to figure out what on earth is going on inside Matthews International's first quarter fiscal 2026 earnings call.
Because it's a complicated one.
It really is.
Yeah.
So we are going to look at the data, we're going to form an opinion, and we're going to give you some actionable insight on whether this stock is, a core holding, a massive trap, or maybe a misunderstood gem.
And doing that requires something that a lot of casual investors, frankly, just fail to do, which is looking past the headline of a press release.
Oh, for sure.
Because, if you only looked at the top line numbers that Matthews blasted out to the wire services this quarter, you'd walk away with a fundamentally flawed understanding of this business.
Totally flawed. And we always start with the scoreboard, right? The headline numbers.
The raw data.
Yeah, revenue, earnings per share, all that.
Yeah.
And I'm looking at the top line revenue for their Q1 2026 right now, and consolidated sales came in at $285 million.
Which sounds like a lot, but
I know what they did a year ago. A year ago, in that exact same quarter, they brought in $415 million.
Yep.
So we are looking at a $130 million crater in quarterly revenue.
It's a huge drop.
I mean, that's a 30% drop.
Yeah.
But then in the very same breath, they reported a massive GAAP net income of $43.6 million, or like $1.39 per share.
Right.
Last year they lost money. This year they made a fortune. So wait, top line revenue collapses by a third, but GAAP profit skyrockets.
It doesn't make sense on the surface.
It doesn't. The only way that math works in the real world is if management liquidated a massive asset to hide a bleeding core business.
Yeah.
So what exactly did they sell?
You hit the nail on the head there. That massive GAAP profit is a complete mirage.
A mirage.
Yeah, it's just an accounting artifact of a massive corporate yard sale. Over the past year, Matthews has been aggressively divesting, meaning selling off or spinning out large segments of their legacy operations.
Okay, so just dumping businesses?
Exactly. Specifically, they spun out their SGK business into a new entity back on May 1st of 2025. Then they completely sold off their European packaging and tooling businesses on December 1st.
Wow.
Yeah. And Dan Stopar, their chief financial officer, he noted that the absence of those specific businesses accounted for about $120 million of that $130 million revenue drop.
Oh, okay. So they didn't lose the customers. They literally just sold the stores that were servicing those customers.
Precisely. The revenue didn't vanish. It just belongs to someone else now. But that still doesn't explain the massive $43.6 million net profit, right?
No, it doesn't.
Because they actually took losses on some of those European divestitures just to get them off the books.
Just to be done with them.
Right. The real golden goose this quarter, the transaction that just drastically skewed their GAAP reporting, was the sale of their warehouse automation business.
Ah, okay.
They closed that sale for $225 million in cash.
$225 million. And I noted in the transcript that Joe Bartolacci, the CEO, made a very specific point to brag about the valuation of that deal.
He was definitely taking a victory lap.
He really was.
Yeah.
He said they sold it for highly accretive 15 times adjusted EBITDA multiple.
Yeah, classic Wall Street speak.
Right. So let's break that down for the listener, because accretive is one of those words Wall Street executives just love to throw around to justify M&A activity.
It's their favorite buzzword, for sure.
Yeah.
So let's look at the mechanics of this. EBITDA, as we know, is earnings before interest, taxes, depreciation, and amortization.
Right.
It's essentially a proxy for the raw cash a specific business unit generates, before the accountants and the tax man get involved.
Before everyone takes a slice.
Exactly. And a multiple is just how many years of that cash flow the buyer is willing to pay up front.
Okay, so the buyer looked at the warehouse automation unit, saw how much cash it generated in a single year, and handed Matthews a check for 15 times that amount.
15 times. And in the world of industrial manufacturing and automation, a 15x multiple is a massive premium.
Really? What's normal?
Typically, these legacy industrial businesses trade closer to 7, 8, maybe 10 times EBITDA on a great day.
Wow.
By getting 15 times, Matthews essentially found a buyer willing to pay tomorrow's absolute best-case scenario prices today. And that is where the word accretive comes in.
Okay, explain that part.
If Matthews as a whole company is trading on the public market at, say, 8 times its earnings, and they sell a piece of themselves for 15 times earnings, that is immediately accretive.
Meaning it adds value.
Exactly. It adds value to the underlying shareholder equity. They traded a low-margin piece of their pie for a mountain of high-value cash.
Bartolacci even pointed out that it was an 11 times multiple after taxes.
Still huge.
Right. He basically called it an asset that was highly underappreciated by the market. So they take this $225 million, they book a massive one-time gain on the sale, and boom, your GAAP net income looks like a rocket ship at $43.6 million.
But as you know, you can only sell the furniture once.
Yeah, eventually the house is empty.
Exactly. So to understand how the actual remaining business is functioning day to day, we have to strip out that $225 million windfall and look at the non-GAAP numbers, the adjusted figures.
And this is where the mirage completely fades.
Completely.
Because when you back out the warehouse automation sale, Matthews actually reported an adjusted net loss of $6 million for the quarter.
That's a big swing.
That's a loss of 19 cents per share. Compare that to an adjusted net profit of $4.3 million a year ago. So the core business they actually kept decided to bleed $6 million.
Yeah, it's not a great look.
Walk us through the mechanics of that loss. What happened?
It comes down to 3 main structural headwinds. And it's vital for you, the listener, to understand these because they aren't just one-time flukes.
They're baked in.
They are baked into the new reality of the company. First, there's a structural lag in how they are currently forced to report their earnings.
Yeah.
When they spun out that SGK business, they didn't just walk away. They took a 40% equity ownership stake in the newly formed company, which is called Propolis.
Right, which means they have to report 40% of Propolis's profits or losses on their own income statement.
Correct. But because Propolis is an entirely new corporate entity scrambling to set up its own standalone financial reporting systems, Matthews can't get the data in real time.
Well, that sounds like a nightmare.
It is. So they report Propolis on a 1-quarter lag, meaning the Q1 2026 earnings we're looking at right now only include Propolis's financial performance from July through September of 2025.
So wait, if Propolis had a terrible summer, Matthews have to eat that loss in the winter.
Yeah, exactly.
It creates a weird temporal distortion in their earnings.
It really does. It makes modeling the company incredibly frustrating for analysts. But then the second headwind driving that $6 million loss is purely tax-related.
Taxes, always taxes.
Always. The CFO detailed that they suffered unfavorable impacts from losses in foreign jurisdictions where they were unable to record tax benefits.
I want to pause on that because international tax mechanics can be so dense.
They're awful.
Basically, if a company loses money in the U.S., they can often use that loss to offset future profits, right? Which lowers their overall tax bill.
Yeah, it's like a tax shield.
It's a silver lining to losing money. Mm-hmm. But what Stopar is saying here is that they lost money in certain overseas markets, and the tax codes in those specific countries didn't allow them to claim those losses as a future benefit.
Nope.
So it was just a pure, unmitigated burn of capital with zero silver lining.
Exactly. It's the worst kind of loss. And the third, and honestly most critical driver of the non-GAAP loss is the severe underperformance of their industrial technology segment.
Which we're definitely going to dive deeply into later.
Well, we have to. But to round out the pure data picture, their consolidated adjusted EBITDA, meaning the cash flow from the remaining core businesses, came in at $35.2 million, which is down from $40 million a year ago.
Which makes sense. I mean, if you sell off businesses that generate revenue, your overall cash flow is going to drop.
You can't have your cake and sell it too.
Right. So if the revenue drop is intentional and the GAAP profit is just a real estate style flip of an automation business, The real question is, what is the actual operating narrative here?
What's left of the company?
Yeah, because underneath all this financial engineering, there is a company making physical objects and trying to sell them.
And that operational narrative is incredibly stark right now. Based on the source material, Matthews International is fundamentally operating as a tale of two wildly different corporate realities.
It really is.
But before we look at those two realities, we have to look at what they did with the $225 million, what I call the balance sheet cleanup.
Right. Because when a company suddenly gets $250 million in cash, management has a choice.
They have a lot of choices.
They can issue a special dividend and reward you, the shareholder, instantly. They can buy back millions of shares to artificially pump the stock price. They can go on a wild M&A shopping spree.
Or they can do the boring, responsible thing.
And they did the boring, responsible thing. They paid down debt.
They did. Management had been aggressively promising Wall Street that they would bring their leverage ratio below 3x within a 12-month window. And they actually delivered.
Let's explain the mechanics of a leverage ratio for the listener, because it is like the ultimate measure of corporate survivability.
It really is. Your leverage ratio is your total net debt divided by your annual EBITDA. It is essentially a measure of how many years it would take you to pay off every single penny of your debt if you dedicated 100% of your cash flow to doing it.
Okay, so lower is better.
Much better. In the industrial sector, a leverage ratio above 3.5 or 4 is considered the danger zone.
Because you're choking on the interest payments.
Exactly. It means debt servicing is choking your ability to invest in new equipment or weather an economic downturn. By getting their leverage ratio below 3x, Matthews has fundamentally de-risked their balance sheet.
That's huge.
Their net debt is now down to roughly $506 million. In this first quarter alone, net debt declined by a staggering $173 million.
That is a phenomenal amount of debt wiped off the board. But it's not just the total number, it's the specific debt they targeted.
That's the best part.
The transcript highlights that in January, they executed the early redemption of all $300 million of their 8.625% senior secured notes. And I want to talk about the gravity of that interest rate.
Yeah.
8.625%.
It is absolutely suffocating for a corporation.
To put that in perspective for you, the listener, if you have a massive mortgage at 3%, you barely notice the interest. If you have credit card debt at 20%, it actively destroys your wealth every single month.
It eats you alive.
Right. In the corporate world, an 8.625% interest rate on senior secured notes means the market viewed Matthews as a significant credit risk when those notes were issued.
Yeah, that's a junk bond rate.
Paying nearly 9% interest on $300 million means you are shoveling tens of millions of dollars into a furnace every year just for the privilege of keeping the lights on.
It completely hamstrings a company's ability to innovate. By redeeming those notes early, essentially using the cash from the warehouse automation sale to just wipe that debt off the map completely, Matthews instantly saves $12 million in annual interest expense.
$12 million of pure cash flow magically reappearing on the bottom line every single year moving forward.
It's incredible.
And CEO Joe Bartolacci wasn't shy about what this means. He stated that this move reclaims capital that can now be deployed toward their dividend, toward internal innovation, and toward high-margin acquisitions.
And the debt reduction wasn't limited to traditional bonds either.
Oh, right, the pensions.
Yeah. They also executed a massive cleanup of their pension liabilities, which is something that often flies under the radar of retail investors, but is critically important.
It's so important.
During the Q&A segment of the call, Bartolacci pointed out that just a few years ago, their pension liabilities stood well over $300 million, of which $125 million was completely unfunded.
Unfunded pension liability. That is the phrase that gives corporate treasurers stress-induced ulcers.
It's terrifying.
Let's break down the mechanics of an unfunded pension. When a company offers a defined benefit pension, they are legally guaranteeing a specific payout to their employees when they retire.
Right, a promise.
To do that, the company puts money into a massive investment fund, hoping the stock market returns will grow the pile large enough to cover those future payouts. But if the stock market crashes, or if people start living much longer than the actuaries predicted, the math breaks down.
The math gets very ugly.
Suddenly, the company owes $300 million to its retirees, but there was only $175 million in the investment fund. That missing $125 million is the unfunded liability.
And it's a ticking financial time bomb.
Because legally, the company has to make up that shortfall out of its own pocket eventually.
It is a dark cloud over any balance sheet. But Matthews managed to solve this problem brilliantly.
How do they do it?
Part of their divestiture strategy, specifically selling the European packaging business, Sourasic was finding a buyer willing to assume those pension liabilities as part of the deal.
Wow. They pawned it off.
They essentially paid a European buyer to take the headache away. Through a combination of those divestitures, higher interest rates discounting the future liabilities, and aggressive management, they have slashed their remaining pension liabilities down to well below $10 million.
From $125 million in unfunded risk down to virtually zero.
It's wild.
It is a masterclass in balance sheet stabilization. You take the high multiple cash from a tech sale, you wipe out the toxic 9% debt, and you package your ticking pension time bombs into a divestiture deal.
Operationally, it is brilliant, but it brings us back to the core question. What is the business that remains?
Right. What's left to actually make money?
If we look at the two realities of Matthews International, we have to start with the foundation, what I call the rock, the memorialization segment.
This is the casket and headstone business. And let's be clear, this is a legacy industrial operation. They cast bronze markers, they quarry granite for cemetery memorials, they build massive community mausoleums, and they manufacture caskets.
And it is an absolute cash machine.
Let's look at the specific data. Sales in this memorialization segment grew 7% year over year to $204.2 million for the quarter.
Solid growth.
Adjusted EBITDA rose from $36.6 million to $38.9 million. So in a quarter where the total company revenue dropped by $130 million, the cemetery business quietly grew by 7%.
It's the anchor of the company.
So why the growth? Why is a legacy business throwing off nearly $40 million in quarterly cash flow?
The earnings call highlighted three very distinct drivers. First, inflationary pricing power. Matthews has significant market share, which means when their costs for labor and raw materials go up, they can simply raise the prices of their caskets and bronze markers.
And the consumer has no choice but to absorb it because it's not a discretionary purchase. You don't put off buying a casket because interest rates are high. It's the ultimate inelastic demand.
Exactly. The second driver is pure volume. And this is where the biological reality of the business comes into play. Bartolacci explicitly noted that higher casket volumes were driven by a particularly active flu season.
Oof. It's a grim metric.
It is grim, but higher national mortality rates directly and immediately drive volume in their memorialization segment.
The ultimate non-correlated asset. But the third driver here is where the corporate strategy gets really fascinating. It's their recent acquisition of a company called Dodge.
Oh, the Dodge deal is brilliant.
And I dug into what Dodge actually does because it is the perfect example of Matthews' underlying strategy.
It really is. Dodge is a global leader in embalming chemicals, cosmetics, and funeral home supplies.
Right. They aren't building the caskets. They're supplying the highly recurring consumable liquids and products that a funeral home uses every single day.
Like printer ink, but for funeral homes.
Exactly. If you run a funeral parlor, you are ordering from Dodge constantly. It is an incredibly sticky, high-margin revenue stream.
Yeah.
And in this quarter alone, the Dodge acquisition contributed $10.4 million in sales to Matthews.
But the real story is the math behind the Dodge acquisition, especially when you compare it to the warehouse automation sale we just talked about.
Write that down.
During the call, the CEO walked through the capital allocation mechanics. He explained that Matthews took immediate steps to reduce their initial cash outlay for Dodge by selling off some redundant assets and optimizing working capital.
Okay.
The net result is that their adjusted purchase price for Dodge is going to settle right around $50 million.
Okay, $50 million purchase price. What does Dodge yield?
Management anticipates Dodge will contribute over $12 million in annual EBITDA.
Okay, let's do the M&A arbitrage math here for the listener.
Yeah.
Because this is where a corporate management team truly proves their worth. If they paid $50 million for a business generating $12 million in cash flow, they bought Dodge for a roughly 4 times EBITDA multiple.
Just 4 times.
4 times. Let's connect those dots. They sold their flashy, tech-heavy warehouse automation business for 15 times EBITDA because some buyer wanted to overpay for industrial tech.
Right.
Then Matthews took that cash and quietly...
The integration is practically overnight. They plug the new acquisition into a distribution machine that already touches thousands of funeral homes.
They also highlighted strong demand for their Gibraltar mausoleum business.
Yeah.
And I wondered, why does management care so much about mausoleums versus, like, a standard grave marker?
Because of the pull-through effect. A mausoleum is a massive capital project.
Like constructing a building.
Exactly. When Matthews secures a contract to build a community mausoleum for a cemetery, they secure the high-margin construction revenue, yes. But more importantly, a mausoleum requires hundreds of bronze nameplates, specialized vases, and architectural fixtures.
Oh, I see.
By building the structure, Matthews guarantees that they will be the ones selling all the high-margin accessories that go inside it for the next 20 years. It creates a closed ecosystem of sales.
Now, I do want to push back on the idea that the memorialization segment is perfectly bulletproof, because the transcript did reveal some cracks.
Yeah, it's not totally immune to problems.
The CFO, Dan Stopar, noted that cremation equipment sales were down. Now, they claim that is primarily because they finally divested their unprofitable European cremation manufacturing arm, which is fair. But there is a massive macroeconomic headwind here: copper.
Yes. The analyst Q&A focused heavily on copper pricing, and for good reason.
Let's explain the mechanics here. Matthews is one of the largest producers of bronze cemetery memorials in the world. Bronze is an alloy, and its primary component by a massive margin is copper.
Right.
If you follow global commodities, you know that copper prices have been wildly volatile, driven heavily by the global push for electric vehicles and green energy grids, which require millions of tons of copper wiring.
It's all connected.
It is. So you have this bizarre dynamic where the global transition to green energy is actively driving up the raw material cost of cemetery headstones.
It is a fascinating macroeconomic collision. And Stopar admitted on the call that while Matthews tries to pass these price increases onto the consumer, the raw cost of copper on the London Metal Exchange is sometimes moving faster than their ability to print new pricing catalogs.
How do they hedge that? Because if copper spikes 20% in a month, their margins get completely crushed.
They utilize physical hedging. Stopar explained that they essentially buy out their copper supply for about 6 months at a time.
Okay, so they lock it in.
They lock in the physical inventory and the price, which gives them a 6-month buffer to adjust their consumer pricing if the commodity markets go crazy. But as Stopar admitted, it is a constantly moving target.
So if the memorialization segment is the cash printing rock, despite the copper issues, we have to look at the other side of the company, the side that is burning the cash, what I call the hard place.
The industrial side.
Yeah, their industrial technology segment.
And this is where the financial whiplash happens.
Yeah.
If you are a retail investor looking at Matthews, this segment is the reason the stock price struggles.
Let's run the data. Sales in the industrial technology segment dropped 13% year over year to 69 million. That is a massive contraction.
Massive.
But the cash flow is what hurts. Adjusted EBITDA swung from a 1.8 million profit a year ago to a 4.5 million loss this quarter. So they're actively bleeding 4.5 million in cash just to keep this division open.
It's painful.
Walk us through the mechanics of this collapse.
The bleeding is coming from 2 distinct areas, but the most severe wound is in their energy solutions business. This is the division of Matthews that designs and manufactures the highly complex equipment used in the production of electric vehicle or EV battery.
Right, they are making the batteries. They're making the machines that make the batteries.
Exactly.
It's a classic pick and shovel play for the EV gold rush.
It is. But right now, the global EV market, specifically in Europe and the United States, is facing severe near-term headwinds. Consumer demand for electric vehicles has softened.
People just aren't buying them as fast.
Exactly. And because demand has softened, the massive battery manufacturers are delaying their capital expenditures. They are pausing the construction of new gigafactories.
Right.
And if nobody is building a gigafactory, nobody is buying Matthews's extremely expensive battery manufacturing equipment.
So the miners have realized there might not be as much gold in the EV mine as they thought, or at least not on the timeline they originally projected, so they stopped buying shovels.
Perfect analogy.
And Matthews is sitting there with a warehouse full of very expensive shovels, burning 4.5 million a quarter, waiting for the phone to ring.
That is the macroeconomic reality of their energy division right now. But that wasn't the only unforced error in the industrial segment. We have to talk about their product identification business and the Axiom printhead delay.
Yes, I read this part of the transcript multiple times because the physics of it are fascinating.
It's so interesting.
So aside from EV batteries, Matthews has a division that makes industrial printers. If you pick up a bottle of shampoo or a box of cereal, there is an expiration date and a barcode stamped on it.
Right, you see it everywhere.
Matthews makes the machines that fire those ink droplets at high speeds on factory assembly lines. They recently debuted a brand new, highly anticipated printhead chip called Axiom at a massive industry trade show called Pack Expo. And Bartolacci claimed the market response was phenomenal.
He did. He specifically noted that they are seeing immense interest from both continuous inkjet users and thermal inkjet customers, claiming this new Axiom technology bridges the gap between the two, expanding their total addressable market to over $3 billion.
Let's explain the difference for the listener, because it highlights why this Axiom chip is such a big deal. Continuous inkjet, or CIJ, is the industry standard for high-speed manufacturing.
It's what everyone uses.
Right. It literally shoots a continuous microscopic stream of ink droplets and uses an electrical field to deflect specific drops onto the packaging to form letters, while the unused drops are recycled back into the machine.
It sounds super sci-fi.
It is. It is incredibly fast. It can print on curved surfaces like cans and bottles, but the resolution isn't perfect, and the machines are notoriously finicky to maintain. Thermal inkjet, or TIJ, is basically what you have in your home office printer.
Oh, okay.
It uses microscopic resistors to rapidly heat the ink until it forms a bubble and bursts out of the nozzle. It produces beautiful, high-resolution barcodes, but historically, it struggles to throw the ink far enough to print on curved or recessed packaging at high industrial speeds.
Precisely. And Matthews is claiming that their new Axiom chip allows thermal inkjet technology to finally achieve the throw distance and durability needed for high-speed industrial environments.
Which is huge.
It is. It potentially renders a lot of older, continuous inkjet machines completely obsolete. It's a massive technological leap.
But they had to halt shipments almost immediately. Why?
Because of the realities of a factory floor. Based on feedback from their beta testing clients, Matthews realized the Axiom equipment needed significantly more electronic shielding.
Explain the physics of that. How does a factory floor mess up a printer?
Think about a modern bottling plant or a packaging facility. You have massive conveyor belts driven by heavy-duty industrial electric motors. You have high-voltage equipment firing constantly.
Lots of moving parts.
Tons. And all of that heavy machinery generates massive amounts of electromagnetic interference, or EMI. It creates invisible electrical noise in the air.
Like static on a radio.
Exactly like static. But in this case, the Axiom printhead is a highly sensitive microchip trying to orchestrate the firing of microscopic ink droplets thousands of times a second based on precise electrical signals.
Oh, I see where this is going.
Yeah. If the electromagnetic noise from a nearby conveyor belt motor hits that unshielded microchip, it scrambles the signal. The printer gets confused, fires at the wrong time, and ruins the barcode.
That's a disaster on an assembly line.
It is. So Matthews had to pause the rollout, take the units back, and engineer heavier physical shielding to protect the chip from the ambient electrical noise of their customers' factories.
And the CEO, he played it off as a minor tweak. He called it a 30 to 45-day delay, framing it as a completely normal hiccup in an initial product launch.
Which happens, but still.
But let's be real. When your industrial tech segment is already bleeding $4.5 million in a single quarter because the EV market stalled, you cannot afford unforced errors on your star product launch.
No, you really can't.
Every week that Axiom revenue is delayed is another week that the casket business has to subsidize the tech division's losses.
Which perfectly frames the overarching dynamic of the company right now.
Yes, and I want to give the listener an analogy here. Because when you step back and look at the brutal contrast between these two segments, I have to ask, is Matthews International essentially a reliable, slightly boring utility company being used as a piggy bank to fund a high-risk venture capital tech startup?
It is an incredibly accurate analogy. The memorialization segment is your utility company. It is generating nearly $39 million in highly predictable EBITDA from biological inevitability.
Steady it.
Exactly. The industrial technology segment is your VC startup. It is losing $4.5 million trying to revolutionize microchips in gigafactories. The cash generated from burials and mausoleums is directly subsidizing the research, development, and operational burn rate of their foray into the global energy transition.
It is a wild juxtaposition of corporate DNA. Death is literally physically underwriting the green energy revolution.
It's poetic in a weird way.
It is, but that brings up the million-dollar question for the investor. Does management actually know what they are doing with this venture capital bet? They fixed the mistakes of the past by paying down the 9% debt. They cleaned up the pension disaster. But what are they promising you right now to justify holding this stock through this tech bleed?
Which brings us perfectly to our third segment, management guidance. Let's look at the future they're trying to sell.
Let's do it.
Management provided a very clear floor for fiscal 2026. The CFO guided for at least $180 million in consolidated adjusted EBITDA for the full year.
At least $180 million. And what about their burn rate? How much capital expenditure, or CapEx, is required to maintain the casket factories and build these new battery machines?
Yeah. The CFO is adamant that CapEx will be strictly capped at around $25 million for the year.
Okay, pretty low.
Yeah. He also anticipates unlocking small working capital benefits of $5 to $10 million through better inventory management. So if you take that $180 million EBITDA, back out the non-cash components, subtract the $25 million in CapEx, and pay the interest expense and the corporate dividend, they expect to be highly free cash flow positive. They will generate cash.
Okay, so the floor is relatively stable. The utility company side of the business guarantees they won't go bankrupt while they figure things out.
Right.
But nobody buys a stock just for the floor. You buy it for the upside. Right. And the upside in Matthew's guidance relies entirely on two massive wildcards. I call them the cash and waiting and the battery supercycle.
Both very ambitious.
Let's tackle the cash and waiting first, because it revolves entirely around propolis, and the mechanics here are complex.
Very complex. We touched on this earlier. When Matthews sold their SGK packaging business, they didn't just walk away with a check. They retained a 40% equity stake in the newly combined entity, Propolis.
Right.
But crucially, they also hold $50 million in preferred equity in Propolis, which carries a 10% PIK interest rate.
Okay, I know what a PK note is in private equity structuring, but let's break down exactly how it functions here on Matthew's balance sheet for the retail investor.
Sure.
Because 10% interest on $50 million is $5 million a year. But they aren't actually seeing that cash, are they?
No, they are not. PIK stands for payment in kind. It is a financial instrument designed to preserve the cash flow of the borrower, in this case, Propolis.
So Propolis gets a break.
Exactly. It means Propolis does not write a physical check to Matthews for $5 million every year. Instead, that 10% interest accrues and is simply added to the principal balance of the loan.
Like a credit card.
Just like a credit card. It is an IOU that aggressively compounds over time. On Matthews' income statement, this accrued interest shows up as a benefit. It technically reduces their reported corporate costs on paper, but it does not put a single actual dollar into their bank account until a liquidation event occurs.
Right. It's phantom income. It looks great on a spreadsheet, but you can't use it to pay your own employees or fund a dividend. You have to wait for the payday.
You're just stacking IOUs.
So Matthews holds this growing $50 million IOU, plus a massive 40% stake in the actual equity of Propolis. How much is that 40% stake really worth?
That is the core of the bullish thesis for Matthews. On the call, CEO Joe Bartolacci noted that Propolis is currently operating at an EBITDA run rate significantly higher than the $100 million baseline that was assumed when the merger closed.
So the business is overperforming.
Drastically. Furthermore, Bartolacci highlighted a massive operational catalyst. Propolis is currently undergoing a complete migration onto a unified SAP software system.
Let's explain why an SAP migration is a big deal in the corporate world. SAP is an enterprise resource planning software.
The backbone of a company.
Exactly. When two massive global companies merge, like SGK and whatever European entity it combined with to form Propolis, they usually have totally different incompatible computer systems for tracking inventory, paying vendors, and managing human resources.
It's usually a mess.
It creates massive data silos and immense operational waste. A unified SAP migration forces the entire new company onto one central nervous system.
Exactly. And the financial impact of that visibility is staggering. Management firmly believes that completing this SAP migration alone will unlock $20 million in pure cost synergies.
Just from software.
Just from software. Primarily by eliminating redundant software licenses, streamlining global procurement, and optimizing supply chains. And that $20 million is just part of a total synergy target exceeding $60 million for the combined entity.
Wow. If Propolis is already generating well over $100 million in EBITDA, and they are about to unlock another $20 million just by fixing their software, the total enterprise value of Propolis is massive.
Huge.
And Matthews owns 40% of it. The CEO is treating this as an enormous cash and waiting event. But as an investor, I want to know the timeline. When do they actually see a dime of this value?
Bartolacci provided a very specific, actionable window. He stated they anticipate exiting the business, meaning selling their 40% stake either to private equity or through an IPO in an 18 to 24-month timeframe.
Okay, so 1.5 to 2 years.
However, he also dropped a breadcrumb, noting they hope to begin receiving some actual cash repayment on that $50 million PIK preferred equity, possibly as soon as their third quarter of this current fiscal year.
Oh, that's soon. If Propolis starts paying down that preferred equity in cash, That is found money that Matthews can immediately funnel toward paying down even more of their own debt.
Absolutely.
But that massive equity exit in 18 to 24 months, that is the true catalyst. That is the lottery ticket management wants you to wait around for.
And it is a compelling reason to hold, but it is only half of their future narrative. The other massive bet they are making to justify the current losses in the industrial technology segment is what the CEO repeatedly called the battery supercycle.
Yes, the EV narrative.
Okay.
During the prepared remarks, management heavily touted that they currently have a $100 million lead pipeline for their dry battery electrode technology, or DBE.
A huge pipeline.
And more specifically, they're waiting on a very tangible $50 million order for a U.S. battery separator line. The CEO claimed the technical team for this massive client has already approved the equipment's efficacy, and they fully expect it to convert from a quote into a firm order later this fiscal year.
But to understand why Matthews is so obsessed with this, we have to dive into the mechanics of dry battery electrodes. Why is this specific technology considered the holy grail of EV manufacturing?
It all comes down to the traditional way lithium-ion batteries are made. Historically, the industry uses a wet slurry process.
Sounds messy.
It is. You take the active battery chemicals, you mix them with a highly toxic solvent, usually something called NMP, to create a wet sludge.
Yeah.
You coat the metal battery foils with this wet sludge, and then you have to run those foils through absolutely massive drying ovens to bake off the toxic solvent so you are left with a dry chemical layer.
And those drying ovens are a nightmare. They take up nearly half the physical footprint of a gigafactory.
Half? That's insane.
Yes, they consume immense amounts of electricity just to generate the heat, and you have to capture and recycle the toxic solvent vapors, which requires even more expensive equipment.
Exactly. It is highly inefficient. Dry battery electrode technology completely eliminates the wet slurry in the ovens.
It's a game changer.
Instead of mixing a sludge, you take a dry chemical powder and use highly engineered calendaring rolls to physically compress the powder directly onto the metal foil under immense pressure.
Just squish it right on there.
Exactly. It requires significantly less physical space, it uses a fraction of the electricity, and it eliminates the toxic solvents. It drastically lowers the cost of building an EV battery. And Matthews International, through their energy division, manufactures the proprietary calendaring machines that compress that powder.
They own the intellectual property for the shovels in this specific gold rush.
Right.
And Bartolacci spent significant time on the call quoting industry giants to validate this macro shift. He noted that LG explicitly confirmed its goal to begin full-scale commercial production of dry battery electrodes by 2028.
Okay, so LG is on board.
He also quoted the CEO of Samsung, who identified the 2026 to 2027 timeframe as a pivotal period, a true battery supercycle, where demand growth and cost pressures will finally force next-generation DBE technology into mass production.
But why is Matthews so focused on the North American market specifically? Why are they waiting on a $50 million U.S. order?
Tariffs. This is purely a macroeconomic supply chain shift. The CEO explicitly cited U.S. tariffs on Chinese-made batteries and battery components.
Politics impacting manufacturing.
Always. Whether you agree with the tariffs or not, the economic reality is that they are pushing massive Korean battery manufacturers like LG and Samsung to aggressively expand their localized manufacturing presence in North America to avoid the import penalties.
Build it here so you don't get taxed.
Exactly. Furthermore, demand for stationary energy storage systems, the massive grid-scale batteries that stabilize solar and wind farms, is expected to double globally by 2030. Matthews believes they are perfectly positioned to provide the complex manufacturing equipment for these new, localized North American supply chains.
I hear the narrative. It sounds beautiful on a PowerPoint slide, but I am going to push back incredibly hard here on behalf of the retail listener.
Go for it.
Management sounds supremely confident. They are throwing around phrases like battery supercycle, dry electrode revolution, and $100 million pipeline. But let's look at the cold, hard reality of the current quarter. They are actively losing $4.5 million in this specific segment right now. And if you read the transcript carefully, the CEO literally admitted during his prepared remarks that, quote, "Our near-term expectations for the dry battery electrode market has decreased." And later in the Q&A, he explicitly confessed, "The timing of orders in our energy business is somewhat out of our control."
It is the vital point of critical analysis for this quarter. Management is banking the entire future of their industrial division on a massive macroeconomic shift, the transition to EVs and localized domestic battery production that they have absolutely zero control over.
Zero control.
They have perfected the design of the shovel, but the miners are delaying the start of the gold rush because interest rates are too high to build gigafactories.
And I question their optimism about the timeline. One of the analysts on the call, Liam Burke, directly challenged Bartolacci about, quote, activity.
Yeah.
He wanted to know how real this pipeline actually is.
Yeah, that was a tense moment.
And the CEO was forced to admit that while that specific $50 million separator order is the big ticket they're waiting on, the rest of the $100 million pipeline is made up of multiple customers who merely have the potential to place large orders down the road.
Potential is not revenue. Potential does not pay the interest on the remaining debt. And potential certainly does not pay the shareholder dividend.
Exactly. And another analyst, Justin Bergner, tried to pin down what was actually active in the EV pipeline versus just general stationary energy storage, which is a slower moving market.
Right.
The CEO insisted they are actively quoting in the EV sector, but he then made a very revealing pivot. He noted that to protect their own cash while they wait for this super cycle to eventually materialize, Matthews is actively exploring strategic partnerships and direct investments to expand adoption without incurring heavy capital expenditure themselves.
That is a critical translation moment. When an industrial CEO says they are looking for strategic partnerships to expand adoption without CapEx, what they are really saying is, we refuse to spend any more of our own money building out this technology right now because we frankly aren't sure when the actual orders will show up.
We need someone else to pay for it.
Exactly. So we are looking for a bigger partner with deeper pockets to foot the bill and share the risk.
It's an admission of vulnerability. They believe deeply in their intellectual property. They genuinely believe their calendaring tech is a global benchmark for DBE. But they are terrified of bringing through all the cash generated by the memorialization segment while they sit around waiting for LG and Samsung to finally break ground on new factories.
And that tension is what makes Matthews such a complex investment right now.
Which brings us to the most important part of the deep dive. We have gone deep into the weeds. We have unpacked the gap accounting mirage, the massive 15x automation sale, the brilliant 4x Dodge acquisition, the debt and pension cleanup, the highly profitable casket utility, and the cash-burning gigafactory venture bet.
We covered a lot of ground.
It is time for the bottom line. We promised the listener an opinionated, actionable takeaway. Let's debate this. Give me the strongest bullish argument, and I'll give you the bearish reality, and we will hash out a verdict.
Okay, the bullish angle is unequivocally a story of structural de-risking. The existential threat to Matthews International has been entirely removed.
Meaning the debt.
Yes. By executing that warehouse automation sale and using the cash to drive their leverage ratio well below 3x, while simultaneously wiping out a $125 million unfunded pension liability, the balance sheet is suddenly pristine. The 9% debt anchor is gone, saving them $12 million in cash immediately.
Okay, the house isn't going to burn down. But where is the growth?
The growth is in the optionality. If you hold MATW right now, you own a foundationally stable memorialization business, fortified by the highly accretive Dodge acquisition that generates more than enough reliable cash to easily cover their 25.5-cent quarterly dividend.
You're getting paid to wait.
You are literally getting paid to wait. And while you collect that dividend, you are essentially holding two massive free call options. You hold a call option on the monetization of that 40% Propellus equity stake, which is growing its massive $100 million EBITDA through SAP synergies and is slated for an exit in the next 18 to 24 months.
Okay, that's one option.
And you hold a second call option on the proprietary intellectual property of their dry battery electrode tech. If that EV supercycle actually hits in 2026 and those $50 million orders start dropping, Matthews owns the bottleneck technology. If either of those catalysts hit, this stock re-rates significantly higher.
Okay, that is a compelling narrative. But here is the bearish angle for the investor sitting on cash today, wondering if they should buy in. The bearish angle is that the industrial technology side of the house is a black hole.
It's definitely bleeding.
An active $4.5 million EBITDA loss in a single quarter cannot be ignored or papered over with promises of a super cycle. The promised energy orders keep getting pushed to the second half of the year, which is a classic Wall Street stalling tactic.
True.
The Axiom printhead delay proves that executing hardware in industrial environments is incredibly difficult and prone to unforced errors.
And the EV market is genuinely stalling globally.
It is. Ford is pulling back, GM is pulling back.
Yeah.
If the legacy automakers slow their rollout, the battery manufacturers slow their gigafactory construction, and Matthews gets left holding the bag.
Domino effect.
Furthermore, even their bulletproof memorialization business is facing real margin compression from skyrocketing global copper prices. They are trying to hedge, but copper moves faster than their pricing models. If the EV market remains frozen in a high interest rate environment, that industrial tech segment is going to drag down the corporate earnings quarter after quarter, essentially neutralizing all the cash generated by the cemetery business.
Both realities are entirely true simultaneously. The balance sheet is safe, but the growth engine is stalled and burning fuel.
So how do we synthesize that into the Talk Tickers verdict? What is the actionable advice for the retail listener?
I believe if you are already in the stock, you do not sell here. The downside risk was the debt, and the debt is gone. The $225 million automation sale cured the disease. So for existing investors, this is a clear hey sold deal.
I agree with that.
You sit on your hands, you collect that reliable 25.5-cent dividend funded by the flu season and Dodge embalming fluid, and you wait to see if management can actually execute the Propolis exit or sign an energy contract without bankrupting the core business.
I totally agree with the whole D for existing shareholders. The panic phase is over. But for new capital, if a listener is sitting on cash today and looking for a place to deploy it, I argue this is a hard wait for the whites of their eyes situation.
Don't jump the gun.
The opportunity cost is too high to lock up fresh capital waiting on a macroeconomic shift that management admits is out of their control.
You want to see proof of life in the EV division?
Exactly. I would tell a new investor, do not buy this stock based on a hypothetical $100 million pipeline PowerPoint slide. Do not buy this stock based on a promised battery supercycle quoted from a Samsung CEO.
Talk is cheap.
Wait until that specific, tangible $50 million U.S. separator order actually hits the press wires as signed, sealed, and delivered revenue. Because until that ink is dry, buying Matthews International is just funding a highly speculative venture capital project with casket money.
It is the most prudent approach. Let management prove the industrial technology model actually works in the real world before you underwrite it with your own fresh capital.
So, as we wrap up this incredibly deep dive into the corporate machinery of Matthews International, I want to leave you, the listener, with a final puzzle to mull over.
Something to think about.
It is the philosophical contradiction that I haven't been able to stop thinking about since I first parsed this earnings transcript. Matthews International brilliantly utilized a 15x EBITDA divestiture to clean up decades of toxic debt and pension bloat. It was an absolute masterstroke of aggressive financial engineering.
Truly impressive.
But as they transition into this next era, the core question remains. Can a legacy, century-old company that historically excels at pouring bronze, building granite mausoleums, and selling embalming fluid truly innovate at the absolute bleeding edge of electric vehicle gigafactories and high-speed microchips?
It is a profound question of corporate identity and culture.
Are those two distinct corporate DNAs fundamentally incompatible? Can the slow, steady, deeply traditional biological clock of the cemetery market successfully coexist under the exact same roof as the hyper-volatile, hyper-competitive, bleeding-edge tech world of the global energy transition?
That's the big unknown.
I honestly don't know the answer. But if you decide to buy and hold this stock, you're making a bet that they can. Keep digging into the numbers, keep demanding the mechanics behind the headlines, keep asking the hard questions, and we'll see you next time on Talk Tickers.